One. Hi, everyone. I'm here with Philip Peterson, our Chief Investment Strategist. Many of you are very used to talking with Philip. You've met him in the past in some live events. But also, I hope you're getting used to the ability that Philip is giving us to spend some time talking a little bit about what he does, what his thoughts are for the future, and also, this is an interesting aspect, is to actually see a little bit exactly what he does. Hey, Philip, thank you, by the way.
Oh, my great pleasure to be here, and great pleasure to have you here. And I apologize for all the ringing in the background, but those will be the notifications that are going off.
So you may wonder where we are. Well, as it turns out, we're actually in Toronto. This is actually Philip's office, and so he graciously let us in through the security. But the reason that Philip offered to do this is because my son is going to university here, and so we're dropping him off. And I thought, you know what, I'll give Philip a call and just see if he's willing to do this. So thanks, Philip. And again, just on behalf of everybody, again, I know your time is precious, but I am really, really curious, though, to be able to see actually live what it is you have going on behind us. So before we start talking about the things I know you love to really talk about, which is what you see coming, et cetera, and how the markets are and what you see with the portfolios, but I'd maybe touch a little bit on what's going on behind us.
Sure. So what's behind us are the screens that we look at, myself and my team, just about every single day. It's a Bloomberg terminal, and so it gives us immediate market information. And it's not just market information, but it's all economic data, not only in Canada and the United States, but all around the world. So it's how we stay in touch with what's going on. And the information that we have on these screens, we pull out and we can play around with, or we model, we include in various regression models that help us to identify the trends that are taking place in the marketplace and where we might be going over the coming 6, 12, 18 months.
You know, and it's interesting because as we were talking about this just a few moments ago, you did bring up one, which I think is here on the left side, and you were talking about trends, right? And things that are actually ironically predictable that people wouldn't see as a trend, which is what this screen is. Do you want to just tell us a little bit about it?
Exactly. So what we have here, it's a seasonality heat map. So what we're doing is we're mapping out each of the months of the year for the S&P 500 for its performance and seeing if there's a trend where some months are better than others. And what you tend to see, it might not be entirely clear, but in September that we're in right now, September on average tends to be the worst month of the year for the S&P 500. You have a higher probability of having a negative return in September than any other month, and it's what tends to scare some people, but it's actually quite normal. It's what we expect. Now, it's interesting. Does it become a self-fulfilling prophecy that people believe September is bad, so they sell in September and therefore perpetuate the negative of the month? We don't know, but it's one of the things that you have to pay attention to. It's not just fundamentals, it's not just corporate reports, it's also the seasonality and sentiment of the market because it's human driven, it's emotionally driven. And so knowing this and paying attention to this can open up opportunities. So for example, a lot of people would look at this and say, well, September is the worst month, we should sell. In fact, September is the worst month, we should buy. It gives investors an opportunity to buy when the market pulls back. And that's what we are actually hoping for. We've been adding into equity through the year, and we are hoping that September will see a bit of a pullback so we can add more to equity.
Yeah, totally, completely reverse on what any client typically wants to hear. Hey, good news, we're coming into what we typically see as the worst month of the year. Over a 20-year history, I think, is what we're looking at here,
Exactly.
right? But I understand, right, staying invested is important because 55% of the time, the S&P 500 is negative in September.
Exactly.
But that means 45% of it is positive.
Right.
Right?
Yeah,
so, and you don't know
perfect.
which one it's going to be. Right?
Exactly.
Yeah.
But it's also following these trends saying, well, regardless, September is actually a good time to buy one way or the other because you head into November, which we pointed out here. November on average has a monthly return of just over 2%, which is the strongest return of the year and the strongest month for a positive return. So it's almost like, well, if you believe that this trend can continue, it's called the Santa Claus rally or
Sure.
whatever you might want to call it, but it's a strong period, and this is when you actually want to be invested.
Yeah, really interesting. What was the second, I know the answer, what was the second best month of the year?
Second, well, we saw July.
Yeah.
July
yeah,
also
yeah.
has a positive return on
Yeah.
average of just over 2%. And we had a very strong July this past year, which was 2.1%
Yeah.
for the month. It was 2.1%. So another strong return for July.
So, one of the things that I looked at when we were, again, I'm a trend person myself, meaning I just like to look at these things like you do, and not to the same level, of course. But when I was looking at this, I thought, what's interesting is that over the last 20 years, the months are very consistent in showing what they show, right? You show the data points. It doesn't seem to really matter who the prime minister is,
Right.
who the president is, right? Does it?
No, exactly. I mean, that's key, and we were chatting about that this morning. Despite all of the volatility, all of the noise, all the speculation this past weekend, has Trump had a stroke or is he dead? And well, he's alive and well. But all of this that's going on, people think it has an impact on the market. And yet, look at where we are. The S&P 500 is up 9%. The European stock market is up 9%. In Canadian dollar terms, it's up 17% because the euro has been so strong. The TSX is up in the mid-teens. So this is something that people might not have thought of at the beginning of the year, or in fact, they may have predicted, oh, it's going to be a bad year because of the tariffs or because of Trump or because of whatever. And in fact, the markets look past all that noise and focus on the fundamentals and some seasonality. And the fundamentals have been improving throughout 2025.
Yeah, and again, this is something I did want to touch on because, you know, in our meetings, you know, if I had said to, and I've said this many times with clients of late, though, is you know, if I said to you, hey, by the way, in July there's going to be, you know, there's going to be a new U.S. president coming into power, somewhere around April 2nd or 3rd, he's going to go on TV and he's going to tell everybody, hey, now it's our game, right? And we're going to be followed by the most rapid market decline, right? Probably in about 10, 15 years, maybe longer.
COVID shocking. Might have been as steep, but it was sharp, it was quick. And it was just one direction down.
That's right. Forever changing the relationship of that country with many other trading partners, or at least for the foreseeable future, right? And again, it's their prerogative to do this. Would you have sat here, and I ask clients this, would you have sat here at this time and said, you know what, the S&P should be up 9%?
Well, yes. You know, as odd as that seems, when we put together our 2025 outlook, now actually 9% is better than what we thought because valuation in the U.S. is full. But we thought earnings would come in around 7 to 10%, but that would give way to a little bit of a valuation contraction, and we would end up somewhere between 5 and 7. So 9, we're thrilled. You know, we always like to make more money, but the positivity that we saw, it wasn't a surprise in the marketplace because underneath all of the noise, companies are doing well. And companies will continue to do well and navigate the various political environments with the profit motive in mind. And so that is really what drives markets over time, not politics, profits.
So one of the things that you and your team have done, of course, you're always shifting these portfolios. We call, you know, they're discretionary, which means you and your team have the discretion with all of the other 20 plus companies, sub-advisors that you use to move the needle. And by moving the needle, you have discretion to move more in Canada, more in the US, more large companies, more smaller, more bonds, et cetera, correct? So with that in mind, you had shifted the portfolios quite dramatically towards the Canadian marketplace and gold, right? Now, in my career, I would have to go back 20 years since I last saw that much of a overweight, not an overweight, but a larger position in Canada than compared to the US historically than over the last 20 years. But yet you made the move, and you just told me the S&P 500 is up 15%-ish.
Well, the TSX.
TSX, I'm sorry.
Yeah,
TSX,
and you're right. So now we had a relative overweight to Canada. We didn't have a bigger weight in Canada than the U.S. U.S. is still the biggest position in the portfolio. But when you look at, if the target weight is going to be, say, 40% U.S. and 20% Canada, on a relative basis, we had a bigger or had stronger conviction in Canada at the time than the U.S. coming into 2025 because of some of the volatility that we anticipated due to the tariffs that were not yet known at that time, but potentially coming.
So yes, I didn't state that quite carefully, but again, the weight that we have in Canada is the largest that I had seen in 20 years.
Potentially.
Yeah. So behind that, of course, was the tariffs and the tariff announcements. And certainly, here in Ontario, the one thing I have noticed is there is a lot of Canadian flags hanging. I've seen it everywhere we go. I've seen it on buildings everywhere. I see it in front storefronts. I see it on cottages. I've seen it driving down the highways. Very much Canada proud. And certainly that makes sense because the province that probably has the greatest effect on it at the moment is going to be Ontario because of tariffs on things like steels and aluminum, et cetera. Yet you're so positive on Canada. I'd love to hear your viewpoint.
Well, we have to carve out the difference between Canada, the economy, and the patriotism versus Canada, the stock market. The Canadian stock market is very different from the Canadian economy. Canadian stock market is more levered to Energy, which is oil, that's a global commodity. Metals, whether it be precious metals or base metals or lumber and its byproducts, those are global commodities as well. And that'll make up, we're looking at about 45% of the index. Now, in metals itself, gold is a bigger weight than copper, nickel, and lithium, and so on. And so having a view that, hey, you know what, we think gold can continue to rally, and it has. It's up 50%, I think, through the year so far, and I think has room to go. That would lift the TSX. Energy has been kind of flattish. Oil hasn't really moved that much, but we think it can over the coming year or two. But these are the global exposures that we have in the TSX, that no matter who's prime minister, no matter what's happening in Ontario or Quebec or BC, these commodities are driven by global demand. And so we saw that as a positive reason to own the TSX.
Yeah, and so again, clients, they, money's emotional, of course, right? And there's nothing more emotional than a news byline. Right? As you said, this weekend, did Trump have a stroke? Is he in trouble? Right. Is he in the hospital? They're hiding something. But it turns out, no, he's actually quite fine. He's just a fellow working hard, and he's older.
Yes.
Right? Yeah. But so tell us a little bit about what you see for the future, because this is what everybody always wants to know. What do we see?
So this is the good news. Right, we've come through the tariff tantrum. We have a better idea of where we're headed, which is there's likely to be a 10 to 20% permanent tariff on various products coming in from countries around the world. Although that can change, because we had the court ruling just the other day that said the tariffs under the IEEPA, which are the tariffs against fentanyl, the tariffs against trade deficits, and so on, that those have been deemed illegal. We'll see what the Supreme Court says about it. But nonetheless, that story's been played out. We know where we're going to end up. So it's no longer a factor into the markets. So now we return to the fundamentals. And what are we seeing in the US? Well, housing is starting to improve. Right? We're seeing housing starts tick up. And we measured on a 12-month moving average, and that's starting to show positive, which is good for the US economy. We're seeing manufacturing starting to recover from the tariffs. Orders are coming in. This is good for the US economy. So we see more pluses than minuses for the US economy, and therefore for the global economy overall. Europe is starting to invest more in infrastructure and defense spending and so on. That's positive. Canada is walking the line, but nonetheless, for the markets, the economies that matter are performing well, and we are more bullish. And we put it this way: the burden of proof is on the bears, not the bulls, because there's plenty of evidence for the bulls to remain bullish. There's very little evidence to be bearish. Usually it's like, well, we think there's going to be stagflation. We were in Boston last week, heard a lot of that. And when we asked, saying, well, where's the evidence? Said, well, we don't have any yet, but it could be coming. Now, if everyone is saying it, it's not going to happen.
Yeah, that's right. It's really true.
And there's no evidence to support it, but there is evidence to support that the U.S. economy continues to advance and continues to grow. We just came through last quarter that showed 3.3% annualized economic growth. That's good. That's not bad. So there are more signs that things are continuing to improve than weakening.
Yeah, interesting. Once again, looking back 4 or 5 months ago, this is not the answer I think average person would have thought coming, which is the tricky part of investing. Investing is about time in it, but it's about data, and it's not about emotion. And what I love about you and your team, of course, it is just pure data.
That's it.
One other question too. So now that we're heading into the fall, and the one question that I know I'm going to be getting is, where do you think the Canadian dollar is going to be?
Right, great question. So we model out the Canadian dollar in a number of different ways. And the biggest impact on the Canadian dollar over the last 20 years has been the price of oil and the difference in interest rates between Canada and the United States. We believe that the Bank of Canada might have one more cut in them, and then that's it. But we know the Fed is going to continue to cut. So as interest rates get closer and closer, that fair value for the Canadian dollar relative to the US becomes a little bit more certain, I would say. So we have a range right now of 71 to 73 cents. And we think that's where we're going to end up. Fair value is right around 71 cents. We're about 72 and a half today.
Right now,
we could see a little bit of downward pressure coming on the Canadian dollar, but just modest.
Yeah.
So 71 to 73 is the tight range that we think.
Okay. So what you see is what you get, in other words.
Right now, yes.
Yeah, good. Yeah, love holding you to this stuff.
Uh,
No, I'm teasing. Well, listen, Philip. We have a couple more minutes, if you don't mind. Again, I know you have really important things to do, and I'm stealing you away from them. But again, our clients appreciate the access that you provide us. By the way, is unsurpassed, right? And I understand we have a personal friendship, but you do go above and beyond, and I really appreciate it. But I really wanted to ask you from a bigger point of view is that you have a 30-year career in this business, highly successful past everywhere you've been. I know this, and we've had personal discussions. So I'm going to hold you to it. Why IG?
Right. So I was at my last company 22 years. And at the time, really didn't have any thought that I would leave. I was very happy with what I was doing. But then I was approached by IG to consider coming over. And I had worked with our CEO before and felt very strongly about him and understand his ambitions and how he sees running a company. And our interests were very aligned that way. I want to work for a company that wants to be the leader in financial and wealth planning for Canadians. And having gone through my due diligence of meeting everyone up and down so that I knew what I was getting into, it just continued to build my confidence that this was a company that provided our advisors, like yourself, the right tools to be successful, to provide our clients with the best advice out there. Not just on, well, we're going to own this and you're going to see gains of whatever. I mean, no one can predict that. More importantly, it's about the planning. And I've gone through it myself. My family and I, we are IG clients, and we've gone through everything in terms of the living plan and have seen the difference that an IG advisor brings to the table versus those that I worked with in the past. And it is night and day. And that allows me confidence that what I do will contribute to that success. And so that I wanted to be a part of that, and that's what brought me here.
Yeah, really, but well said. We should probably record that. Oh, we did. Well, you know what? You also said one thing that really struck me is that the last company you were with wanted to do well, and they wanted to be consistently, doing okay. But you said, towards the latter end of your career, your legacy is you said, no, I want to win. I want to be number one.
Yeah.
Right? And that's why you came here.
That's exactly it. I impart that upon my team as well. It's like, the question I usually ask when I'm interviewing people is, do you want what's more important, winning the game or playing the game? And I suppose there's no wrong answer here, but for me, I want to be aligned with people that want to win the game. Obviously, you're going to play the game, but you play it for a reason because you want to achieve. And I'm not afraid of failure. I have no problem with failure at all, but I want to fail on my terms, not someone else's. And so that then allows you to be better and to succeed further down the road. And that's what I think we have here.
Yeah, wonderful. So if I'm a client and I'm listening to our chief investment strategist saying the reason I moved here is because I want to be number one, right? I want to have the tools to do it. I believe strongly in what we're doing, what our company is doing, and I'm all in. I'm going to feel pretty good. Right? So thank you, Philip. And I just noticed, by the way, that on your desk here you have a Gibbings & Associate pen, and so I don't know if you just pulled that out for me or if it's something in daily use.
That is my go-to.
But you know what? I'm happy to send you another.
Please, a box if you don't mind.
Okay. All right, everybody, thank you so much again, Philip. I appreciate it.
Thank you.